Well, hello and welcome to our launch event for our annual report on living standards, poverty and inequality in the UK. My name is Tom Waters. I'm an Associate Director here at IFS and a co-author of this report. We're really glad to be able to present this work to you. I think this is the 20th year that IFS have done a report of this general nature. So it's certainly been a long-running thing. And this has been funded by the Joseph Rowntree Foundation. We're very grateful for their support in making this work possible. We'll get going with the presentation shortly. If you have any questions you'd like to ask, do go to the Slido website. If you're watching on YouTube, you can find the link in the video description. There you can ask some questions, and we'll come to the questions right at the end. So we're going to have 3 presentations, and we'll go into the Q&A after that. So we're going to first have Xiao Wei talking to us about living standards, inequality, and particularly focusing on those that have become inactive in the years since the pandemic and what's happened to their living standards. We're then going to go to Sam, who is going to talk about poverty and the government's cost of living payments. And then lastly, to Tom, who's going to present our research on housing and housing benefit. So without further ado, I'll pass over to Xiao Wei to kick things off.
Hi, thanks, Tom. So I'm going to start by talking about what's happened to living standards and inequality since the pandemic. I'll start by giving an overview of how average household incomes have changed and also how incomes have changed across the income distribution. And then I'll focus on the group of older workers who left the workforce over the course of the pandemic and look at what's happened to their living standards and their self-reported well-being. So starting with broad trends. So on this chart here, I'm showing average disposable household incomes over time in the years leading up to the pandemic, where incomes are adjusted for inflation and for household size. So here, incomes are shown expressed as the equivalent for a childless couple. And you see that in 2019-20, just before the pandemic hit, average household incomes were about £30,000 a year. In the first year of the pandemic, despite the massive economic disruption that took place, government support meant that actually there was not much effect on average household incomes, which only fell very slightly that year. And in the year after, in 2021-22, we actually saw quite a strong recovery of household incomes in nominal terms, in cash terms. However, the sharp rise in inflation that we saw since then meant that in real terms, average household incomes increased only very slightly. So before deducting housing costs, average incomes in 2021-22 were still below their pre-pandemic level. This series shows incomes before deducting housing costs. There's a slight fall in housing costs since the pandemic. So after deducting housing costs, we see that by 2021-22, average household incomes had just returned to their pre-pandemic level. So this chart here shows the average household disposable income, so the household income changes at the middle of the distribution. What you see here is that these changes were actually quite different across the income distribution, with growth in household incomes at the bottom of the distribution and falls in the middle and the top of the income distribution. It's worth noting that this pattern of changes is really quite different from the pattern of income growth that we saw in the years leading up to the pandemic, where household income growth, which was much stronger at the middle and the top of the distribution than at the bottom. So to understand what drives these changes in household incomes, what's driven these changes since the start of the pandemic, I'm going to break down household incomes into different components like employment incomes and benefit incomes, and try to understand how these different components have changed since the pandemic and how that contributes to overall household income growth. So we're going to start with households at the bottom of the income distribution, the lowest third of households in terms of incomes. And we see that between 2019-20 to 2021-22, the lowest income households saw a large fall in their net incomes from employment. This reflects both a rise in the share of households at the bottom who have no one in work, and also a fall in average earnings among households that are in work. However, this fall in net employment incomes at the bottom was largely offset by an increase in non-disability benefits. So part of this is mechanical, right? As households' earnings fall, they're entitled to more benefits, but also we saw higher benefit levels at every given level of earnings, reflecting changes to benefit policy, and in particular, the £20 universal credit uplift that was still in place for the first half of this financial year, which Sam will talk about shortly. There was also an increase in disability benefits. So the share of households at the bottom of the distribution that received any disability benefits increased by quite a lot, by 26%, since the pandemic. Now, adding on the other components, taking it all together, household incomes at the bottom of the distribution increased by 2.7% between 2019 and 2021. Looking further up the distribution, we also saw falls in employment incomes at the middle and top of the income distribution, although to a more muted extent than at the very bottom. And overall household income growth was slower at the middle than the bottom, and slightly negative at the top of the distribution, resulting in a fall in income inequality since the pandemic. So I'm now going to shift focus to looking at the cohort of people who became inactive over the course of the pandemic, and looking at what's happened to their living standards. So as you probably know, given that you're tuning into an IFS event, there's been a big exodus of workers from the workforce since the start of the pandemic, especially among older people, so people in their 50s and 60s. And previous IFS work has shown that a lot of these people who are moving directly from work into inactivity were moving into retirement. So for the rest of the presentation, I'm going to use the term retirees very loosely to refer to older workers who've moved from employment into inactivity. And to understand what's happened to their living standards, we look at different cohorts of recent retirees over time and look at measures of their living standards. So in this chart, I'm showing the share of recently retired older people over time who were in relative poverty. And you see immediately that there's a spike in 2020 and 2021, right? So the cohort of older workers who left the workforce in the year right after the pandemic had much higher shares of relative poverty than previous cohorts. And then this share falls back again for the 21-22 cohort, who look much more similar to pre-pandemic cohorts in terms of the poverty rates. It's worth noting that this increase in poverty among the cohort of people who left the labour market in the first year after the pandemic took place at a time when overall poverty rates were falling. So if we look at older people in the same age group who are also inactive but had been inactive for longer, you see that their poverty rates actually fall in 2020 and 21. So here we're looking at poverty rates of different cohorts of recent retirees. We're not following the same people over time, but if we do that, if we move to a data set where we can follow the same people over time, we see a very similar picture of the cohort of older people who retired in the first years of the pandemic, seeing a much larger fall in living standards. So in particular, we look at the Understanding Society survey, which follows the same individuals over time as they move from work into inactivity. And we find that 50 to 70-year-olds who became inactive in 2020 and 2021 cut their food spending by about £60 a week on average. They reported a fall in their subjective assessment of their own financial situation, and they were more likely to end up in relative poverty in the year that they became inactive compared to the year before they left the workforce. These changes for the cohort of retirees in the first year of the pandemic were much larger than for cohorts before the pandemic. So for example, if you look at cohorts of retirees before the pandemic, they don't normally see much of a change in their food spending when they become inactive. And further, these changes don't simply reflect wider declines in living standards among older inactive people over the pandemic. So whilst older people who've been inactive for longer also cut their food spending by a bit over the pandemic, this was a much smaller cut than the £60 seen for the cohort that became active. As well as seeing falls in their living standards, the cohort of older people who retired in the first year of the pandemic also saw big falls in self-reported well-being. So in this chart, I'm again showing different cohorts of recent retirees over time and reporting their self-reported anxiety score. So a higher score indicates more anxiety, lower well-being. And you see here that in 2020, the cohort that retired in 2020 saw a big spike in anxiety, which then fell down again for the later cohorts of retirees. Again, well-being deteriorated across the board over the pandemic. The spike was much bigger than that seen across the population of older people who'd been inactive for longer, which indicates that there was something particular about this cohort of older people who left the workforce during the first year of the pandemic, whereas subsequent cohorts of retirees looked much more like pre-pandemic cohorts. So I think taking together these results on living standards and well-being challenged the perception that the exodus of workers over the pandemic was driven by wealthy people who could afford to retire in comfort. In particular, we find that the cohort of older people who retired in the first year of the pandemic were much less likely to have access to pensions than both pre-pandemic cohorts and the cohort that came after them. And indeed, nearly half of them had neither access to the state nor private pensions in the year that they retired. The fact that so many retired without access to pensions suggests that many may have been forced into early retirement by the labour market turmoil and the health risks, at a time before the vaccine had been rolled out. And this is consistent with existing research that shows that the older people who became newly inactive over the pandemic were predominantly on lower to middle incomes and disproportionately worked in sectors that were hit hard by the pandemic and not amenable to working from home. So people who faced the labour market disruption and also the health risks associated with going into work. It's important to stress that this fall in living standards and well-being was only observed for the cohort of people who retired in the first year of the pandemic, whereas whilst flows into inactivity were still very high in 2021-22, the cohort of retirees in that year looked much more similar in terms of their access to pensions, in terms of their living standards and well-being to pre-pandemic cohorts. So to quickly summarise, the recovery in household incomes in the latest year of data in 2021-22 was stifled by the sharp rise in inflation, so that after deducting housing costs, average household incomes in that year were just back to their pre-pandemic level. However, at the bottom of the distribution, higher working age benefits, partly due to the £20 uplift, offset falls in earnings for low-income households, so that household incomes actually rose at the bottom of the distribution and fell towards the middle of the top, resulting in a fall of income inequality at the bottom of the distribution. Looking at the cohort of people who became inactive over the pandemic, the evidence suggests that actually many older people who left the workforce in the first year of the pandemic may have been forced out of the workforce. They were more likely to end up in poverty, they were likely to cut their food spending and also experience falls in well-being, whereas those who became inactive a year later looked much more like pre-pandemic cohorts. Thanks, I think I'll pass on to Sam now to talk about poverty.
Thanks, Shaway. So I'm going to be talking about the poverty section of the report now. And I'm going to start off by discussing some of the recent trends we've seen in poverty, and then move on to talk a little bit about the government's policies to alleviate it. Firstly, though, there are two key ways in which we measure poverty. So the first of these is absolute poverty. And now in absolute poverty, we have a poverty line that's fixed in real terms, and that's equal to 60% of the 2010 to 11 median household income, and then adjusted for inflation. So in 2021 to 2022, this was equivalent to around £14,000 for a childless couple, and that would be higher for a household with a bigger household with bigger needs and therefore higher income needs. We also measure relative poverty. Now, for relative poverty, the poverty line is not fixed, and it's equal to 60% of the median household income in a given year. And so this means that relative poverty depends not only on the incomes of those at the bottom of the distribution who might fall below the poverty line, but also the incomes in the middle, because obviously that is going to determine where the poverty line is. And so as we look here again for a childless couple, we can see that in real terms, there was actually quite a significant rise in the relative poverty line between 2020 and 2021. So turning to what the trends have been in poverty, firstly, I've got the absolute poverty rate among the whole population plotted here. And as you can see, it tends to fall over time because of the fact that this poverty line is fixed in real terms and household incomes do tend to grow. Now, focusing in on what's happened since the beginning of the pandemic, if we look at the 29 changes between 2019 to 20 and 2020 to 2021, we can see that despite the sort of huge disruption to the economy that happened at the time, there was actually a quite substantial fall in absolute poverty of around 1 percentage point. Now, the reason for this is the fact that the government offered some really quite substantial interventions in terms of welfare that, as Zhao has already alluded to, actually boosted the incomes for households at the bottom of the distribution. Now, since then, some of these have expired, and so we've seen that there's been a bit of an uptick back in absolute poverty. However, still between 2019 to 20 and 2021 to 2022, the absolute poverty rate's fallen by around 0.7 percentage points, and that's equivalent to bringing around 480,000 people out of absolute poverty. We can also look at relative poverty. And as you can see that since 2019 to 20, the trends have been reasonably similar, although certainly the changes have been more stark. And the reason for this is, as I mentioned earlier, relative poverty depends not just on what's happening to households at the bottom of the distribution, but also the median household income. And in 2020 to 2021, the disruption to the labour market meant that there actually falls in median income. And so therefore the relative poverty line fell and fewer individuals fell beneath it. And so there was a quite significant fall in relative poverty. However, in 2021 to 2022, along with sort of the expiry of some of the benefits policies, median income also rose back up. And therefore we get a more substantial increase in relative poverty that year. So as I've been saying, the benefit reforms that were taking place at this time have played quite an important role in driving poverty trends. And there are two specific reforms that happened in the 2021 financial year that we analyse here. So as a sort of overview of what they were, at the start of the year, so in April 2021, the £20 per week uplift to universal credit was still in place. So this was a policy that was introduced soon after the pandemic started. And what it does is it increases families' universal credit entitlements by £20 per week, so more than £1,000 a year, potentially. And this expired at the end of September, and so it was in place for the first 6 months of the year. Now, at the end of November, the government introduced a new policy, which I'll refer to as the taper rate reduction. And this sort of encompasses a series of reforms which effectively reduce the speed at which your benefits are withdrawn as your earnings increase. Now, this was introduced on a permanent basis, and so it was in place for the last 4 months of the year. What we have, therefore, is two different policies that are in place at different times of the year and for different lengths of time. And so what we do is we use microsimulation methods to estimate the effects of each of these on poverty, estimating what the absolute poverty rate would have been if either had been in place for the entire year. And what we're comparing this to is the sort of baseline where neither the uplift nor the taper rate reduction were implemented. So we plot these effects here. Now, on the y-axis, we have the percentage point reduction in absolute poverty rate. So here, a higher bar is going to indicate a larger effect reducing poverty. Firstly, we can look at what happened amongst poverty for the entire population, and we can see that the uplift reform had a much more significant effect at reducing absolute poverty rates than the taper rate reduction. An almost 0.57 percentage point reduction is equivalent to almost 400,000 people less in absolute poverty. Now, it should be said that the uplift costs around £6 billion a year if it were to be implemented on a permanent basis, whereas for the taper rate reduction, it would be more like £3 billion. But even after accounting for these cost differences, we can see that the uplift is just a more effective policy at reducing poverty. And we can sort of see the reason for this by comparing how each policy affects both in-work poverty and out-of-work poverty. Firstly, looking at the effects on in-work poverty, we can see that the uplift and the taper rate reduction have much more similar effects. So while the uplift is still slightly bigger effect at reducing absolute poverty, after accounting for the fact that it costs twice as much, we can see that in this case, the taper rate reduction is more effective at reducing in-work poverty. And the reason for this is that, as I said before, the taper rate reduction reform was really about reducing the rate at which you lose your benefits as your earnings increase. So for those households in work who have some earnings, then they're going to benefit particularly. And we can see this when we look at the effect on out-of-work poverty, that the taper rate reduction has absolutely zero effect for this reason, because these households don't have any earnings, whereas the uplift has a very significant effect on reducing poverty. Since then, the government has used slightly different reforms to try and help households facing hardship, and it's chosen to use these cost of living payments. So a bit of background on these. The UK government is going to be spending almost £19 billion over 2 years on cost of living payments, and these are for households on means-tested benefits. So these cost of living payments are of lump sum, so they're paid relatively infrequently, and they're quite large payments, and they're also flat rate, which means every sort of benefit recipient gets the same amount. The reason that the government is doing this is to compensate for the declining real value of benefits. And this is because the way benefits are uprated each April to match inflation is out of date. And so when inflation is rising quickly, what happens is benefits start to lag behind inflation. So for last year and this financial year, the government is introduced 5 payments, which if you received all of them would total more than £1,500. And each instalment of these is going to at least 7 million households, which explains why it's such an expensive and substantial intervention. So here we've analysed how households spent the very first of these, which was a £326 payment made in July 2022. To do this, we're going to use slightly different data to what we've been using up to now. We use the exact one transactional dataset provided by ClearScore, which is a credit rating agency. This gives us transaction level data from users' bank accounts at a very daily frequency. So this high frequency is going to allow us to measure changes in spending over quite short time intervals. Within this data, we managed to identify almost 100,000 users who received a cost of living payment in July 2022. Now, it should be said that this data comes from people who've signed up to ClearScore, and so it's not supposed to be representative of the UK population. And we do find that individuals getting very low benefit amounts are somewhat overrepresented, and those getting very high benefit amounts are similarly somewhat underrepresented. However, when we look at how the responses vary across people who get sort of a wide range of levels of universal credit, then we find that the responses look pretty similar. Additionally, the spending patterns in our data match those of benefit receiving households in other data sets. And so we're reasonably confident that this fact isn't going to be significantly biasing our results. First off, I'm going to look at how the cost of living payments affected the spending of recipients across 2 broad spending categories. So on the left-hand panel, we have spending on bills. This is monthly spending. And looking at those individuals who received a cost of living payment, we can see that both leading up to the payment and afterwards, there was really quite substantial rises in spending on bills at this time. However, you'll notice that there isn't a big spike at the time of the payment, which might be suggestive of the payment being used to pay off arrears or things like that. Then what we do is we take individuals who didn't receive a cost of living payment, and we find those who have similar spending patterns to those who did before the cost of living payment. And we look at their spending on bills, and you can see that it actually looks really remarkably similar to those who did receive the cost of living payment. So really taken together, this is suggestive that the cost of living payments were mostly not used for spending on bills. On the right-hand panel, we have discretionary spending. So really this should be taken to mean anything that isn't spending on bills. And we can see a very different sort of story emerging here. You'll see that at the time of the payment, recipients increased their weekly spending very significantly. And this is a finding that is sort of found in lots of other studies on these big, large amounts of money being given to individuals or households, that a lot of it tends to be spent quite early on. You can see, though, that for a number of weeks afterwards, so up to 15 weeks after the payment, recipients were still spending more than these sort of non-recipients. So it looks like that the cost of living payment did enable higher spending over a longer period of time as well. Now we can break down this discretionary spending into some smaller categories. So here I've got weekly spending on groceries, but you can see that the pattern really looks quite similar to the larger category. And you get this spike initially of weekly spending of around £5 a week, which then falls away, but recipients are still spending more compared to non-recipients for quite a number of weeks afterwards. And then we can look at spending on entertainments. This includes things such as dining and drinking out or Netflix. And you see you get a similar spike, which then falls away. So it really looks like a lot of the spending is happening quite early on after the payment. Now, entertainment and groceries are two of the most sort of important types of spending in this big discretionary spending category, but there are lots of other that contribute to it as well. Cash makes up quite a large part, although it's hard to know what that's being used for, but also online spending and spending on clothing are important as well. And so really what we can see here is that these cost of living payments were used in sort of quite a varied way. So to conclude, since the beginning of the pandemic, we've seen that actually there have been falls in both relative and absolute poverty. And this is quite surprising given the fact that it has been thought of quite a sort of disruptive time for the economy, but it really reflects that the government has put quite a lot into supporting households at the bottom of the distribution over this period. And one of the most important policies in this was the £20 per week uplift. We found this was a more effective policy at targeting poverty than the taper rate reforms, which have been introduced later and are still in place at the moment. The cost of living payments are what the government has been using since the 2022 financial year to try and help households facing rising prices. But what we've found looking at spending data is that these are blunt instruments and poorly designed for alleviating deprivation. The fact that they're offering these large, infrequent payments makes long-term budgeting challenging. So you see these big spikes in spending initially, which you may not want and you may not get if you paid smaller and more frequent payments. The fact that there's a lack of targeting, so all households receive the same amount, we think contributes to the fact that you see spending across a very wide range of categories. Also, eligibility is just based on a single month's income for this very large sum, and this can introduce unfairness. Household incomes tend to fluctuate throughout the year, and so if your income is just surprisingly high in that 1 month of eligibility, you'd miss out on this more than £300 payment, which is supposed to support you for many months. And so that can also distort incentives to work and create unfairness between households who might across the year have similar income. So really taking all this together, we don't see much reason why these cost of living payments would be a preferable sort of policy design compared to just simply increasing benefit rates to reflect the fact that they've fallen behind inflation. Thanks, that's everything from me. I'm going to hand over to Tom now.
Thank you very much, Sam. And now I'm going to be looking at a slightly more specific topic which determines people's living standards. And that is a topic that's been receiving a lot of attention recently due to rising rents and ongoing policy debates. And that's the quality and affordability of the rental sector, with a particular focus on private rental sector and on people who are on lower incomes. So part of the reason we're interested in looking at renters in particular is that we know that by a variety of measures, they have lower living standards than owner occupiers. So what I'm now going to do is plot a few different measures of living standards. So if I start with the poverty rate measured with overall income and income after deducting housing costs, well, we can see that both these measures of relative poverty are higher for renters than for owner occupiers. And then there's an even bigger difference when we look at the after housing cost measure, showing that higher housing costs for renters are contributing to some, but not all of that difference. Then with some other measures we have, such as the index of material deprivation, which is a score based on the number of important goods that households can't afford, such as being able to afford a warm winter coat or fresh fruit and vegetables. We also see lower living standards for renters, higher rates of people being materially deprived, and on food insecurity measure, it's exactly the same story. So renters having lower living standards by a variety of measures than owner occupiers, and actually in particular social renters. So with that in mind, in this presentation, we're going to have a look at how housing tenure has changed over time and how housing costs and housing quality differ between these housing tenures. And then we're going to look at a specific issue which has become very pertinent recently, and that's how rapidly rising rents and frozen housing benefits have meant that people who are reliant on housing benefits to pay for private rental accommodation are seeing a really shrinking pool of the properties they are able to afford, with consequences for the quality properties they can afford as well. So let's start with looking at changing housing tenure, costs and quality. So the first thing to note actually is that private renting has been significantly on the rise in recent decades, especially since the 1990s. So what I'm going to do is plot the share of individuals in 3 different housing tenures here in 3 different years. So if we start with 1979, we can see quite a small private rental sector of 10%. Most people, this is in the bottom 40% of the income distribution. Most people were social renters or owner occupiers coming a close second. Then if we look at 1995, well, we can see a significant increase in owner occupation rates and a significant decrease in the social renting sector. That's largely a result of the right to buy scheme. Private rental sector, slightly bigger, but fairly similar size. Then if we come forward to 2019, and in that period, there's been very significant increases in house prices. But what you can see is that most of that increase in owner occupation actually reversed for people in the lowest 40% of the income distribution. But the social rented sector also continued to shrink in size. So it's the private rental sector that's filled that gap. And that's why looking at the private rental sector is becoming increasingly important if we want to think about the living standards of people on lower incomes in particular. And so why does this matter? Well, we've already seen that different housing tenures have different living standards on a variety of measures, but I'm now going to look at a few different determinants of living standards that are very closely related to housing, and that's costs and housing costs and quality. So first, let's quickly look at housing costs. And what we're going to see is that private renters have higher housing costs than both social renters and owner occupiers with a mortgage. So what I'm going to do here is plot the median housing costs for private renters pre-pandemic, and that was £730 a month. But we can also see that 10% of renters were paying over £1,900 a month, and only 10% were paying less than £421 a month. And if we compare that to social renters and owner occupiers with a mortgage, we can see that social renters paid a little bit less, particularly at the upper end, and owner occupiers paid substantially less. Now, I should say here, the way I'm measuring owner occupiers' housing costs is only taking account of essentially mortgage interest payments and not mortgage principal payments. That's consistent with how we measure housing costs in official poverty statistics. But even if I included mortgage principal payments, the housing costs of owner occupiers with a mortgage would still be significantly below those of private renters. So that's housing costs. Now let's have a look at housing quality. And for that, I'm going to move over to the English Housing Survey, which is a survey of properties in England, but which has a lot of information on housing quality. And the first measure I'm going to look at is something called the Decent Homes Standard. Now, this is a standard that's actually required of social rented properties. It's a legal requirement, but the English Housing Survey measures this for all different types of properties. So as part of this standard, properties have to avoid failing on 4 different criteria. The first is the presence of hazards in the house. The second is that it's in poor state of repair. The third is that it has poor thermal comfort, which means it can't be adequately heated. And the fourth is that it has outdated facilities. And if a property has any of these criterion present, then it fails the Decent Homes Standard. So if we look at the overall failure rate for private rented properties, social rented properties, and owner-occupied properties, we can see that almost a quarter of private rental properties fail this standard, and that's far higher than owner occupation failure rates and especially social rented failure rates. I should say again, here we're focusing on the lowest income 40% of the population. Now, if I dig into why that is, well, for all the housing tenures, the most common reason for failure is the presence of hazards. Hazards could be things like electrical problems with drainage and sanitation, trip hazards, all sorts of things. And again, it's the private rented sector that's most likely to fail on that measure. And indeed, on all of our other three measures, the private rental sector fares worse. And it's worth noting, even if I didn't focus on lower income households, though these levels would all be lower, the same pattern between these tenures would still emerge, with the private rented sector being performing significantly more poorly. So we've also looked at a few other measures of low housing quality beyond the Decent Homes measure, and it's a fairly similar picture. So at first, we've got two measures of energy efficiency, so EPC grade D or below, and property not double glazed. We can also see high rates of low energy efficiency on these measures for the private rental sector, though it's actually a fairly similar picture for the owner-occupied sector here, with the social rented sector performing the best. Then if we look at problems with damp or insecure premises, well, we can see private rental sector clearly higher rates of these problems than the other tenures. And then finally, we've looked at overcrowding, and that's a problem across the rental sector, and actually slightly bigger problem in the social rented sector, the only measure where the social rented sector performs worse. That's because if you're in the social rented sector and you need a bigger home, it's very difficult to actually move home. But I think the upshot here is that though we saw earlier that on overall measures of living standards, social renters are often the worst off. If we particularly look at features that are related to housing costs, housing quality, actually it's the private rental sector that is perhaps the most concerning, and that is at a time when the private rental sector has become more and more important, more and more prevalent in the lower part of the income distribution. So that's a sort of historic picture, a recent history picture. Now we're going to look at a very live issue, which is the impact of freezes in housing benefit on the affordability of the private rental sector. So around 38% of private renting households receive housing benefit, and some in the social rental sector receive housing benefit as well. Now, housing benefit, if you have a low enough income to be eligible for it, the idea is that it pays the rent, but only if you're in the private rental sector up to a cap, which depends on the size and age of your family and also the local area. And this is known as the local housing allowance. Now, it used to be that this cap was set at the median rent, so families on housing benefit could use that benefit to pay for half of properties. And this was cut to the 30th percentile in 2011. Then between 2013 and 2020, the link to contemporaneous rents was actually broken. So there were various different policies, uprating with inflation, freezing, uprating with 1%. Policy kept changing, but that live link to rents was broken. And the consequence of that was that in a majority of areas, not all areas, but a majority, it actually local housing allowances were not keeping up with rents, and the pool of affordable properties was shrinking over time. Then in April 2020, local housing allowance rates were reset to the 30th percentile of local rents in September 2019 in response to the coronavirus pandemic, but they have remained frozen at that level since. Meanwhile, rents for newly available properties have increased by over a fifth since that freeze, since the time the rents, since September 2019, when the local housing allowance was linked to. So the upshot of that is that the pool of affordable properties has once again been shrinking quite drastically. And we're able to look at this, actually up to very recently, by looking at Zoopla listings. So we're going to be looking at the newly available properties and the proportion of those which can be covered by the local housing allowance. So if we start at the beginning of 2013, well, we can see that the housing affordability, the proportion of properties which can be covered by housing benefit fell from around 21% down to around 11% at the beginning of 2020, as rents increased over those years and local housing allowance lagged behind, as I mentioned earlier. Then, when the local housing allowance rates were increased at the beginning of the pandemic, the proportion of properties which could be covered by housing benefit substantially increased to around 22%. However, as a result of the really rapid growth in rents, which we've seen recently, the proportion of properties which can be covered by LHA rates has really plummeted. And as of the beginning of 2023, so just a few months ago, fewer than 5% of new lets could be covered by housing benefit. Now, if we remember that almost 40% of private renting households use housing benefit, what this is showing is that over time, if this continues, then it's going to be a very small proportion of those are actually going to be able to find a property that they can cover fully with their housing benefit. They're going to have to make up the difference using other sources of income. But it's not just the fact that families are going to be struggling to find perhaps a property that they can afford. It's also that as the pool of available affordable properties shrinks, because those properties are more concentrated at the cheaper end of the market, the quality of those properties is also declining. So we've got a measure of quality here, which is particularly pertinent given the higher energy costs in recent time, and that is a measure of energy efficiency and the average cost of heating and hot water for properties which can be covered by housing benefit. And what we're going to do here is compare the cost for holding constant the number of bedrooms and the area in which someone's looking for a property. We're going to look at how much more expensive it is to pay for heating and hot water for properties which can be covered by LHA rates compared to average properties. And what we can see, it's almost like the previous picture, but upside down. So between 2013 and 2020, as the pool of affordable properties shrank, the heating cost premium effectively increased as the properties which could be covered by housing benefit were less efficient than average. Then that was mostly reversed when LHA rates increased at the beginning of the pandemic, but essentially the heating cost premium has gone up again quite rapidly as rents have increased and LHA rates have remained frozen. And that means that new lets which could be covered by housing benefit now have around 19% higher heating and hot water costs than the average property. We also know on some other measures that affordable properties are lower quality than the average. For example, they are more likely to be in low employment and high crime areas. And we also know from research by the government that being energy inefficient property is highly correlated with failing the decent home standard. So though we don't have data on this, it's likely that the affordable properties are going to be more likely to be non-decent on average as a result of this picture. So just to summarize, private renting has grown in importance for lower income households, while social renting and home ownership have declined in recent decades. And problems with poor housing quality and high housing costs are more common for private renters. And very recently, freezes to housing benefit have drastically reduced the affordability of private rental properties for those on lower incomes, and properties which can be covered by housing benefit are increasingly energy inefficient and expensive to heat. So thank you very much. That's all from me, and now I'm going to hand back to Tom for questions.
Excellent. Thanks, Tom, and thanks, Xiaowei and Sam, for those really interesting presentations. I hope those of you listening found them as interesting as I did. We've got a bit of time for questions and answers now. As I mentioned before, we have the Slido website, which you can find a link to below the video where you're watching it, where you can submit a question. We've already got a bunch of questions, so let's dive right into the one that's been voted up the most. Which is, do we have any longitudinal data on whether the older workers who left in the pandemic into poverty are now returning to work? So I think that's a very good question. Xiaowei, can I send that one in your direction? Do we know about anyone returning to work?
Yeah, sure. No, that's a good question. So we looked at this question back in March using longitudinal data. And I think back then we did see an uptick in recent sort of retirees or recently inactive people flowing back into the workforce. We saw then as well that there was sort of an indication that that was a trend that was going to continue, given that there was also an increase in the share of people who remained inactive, who said they either wanted to work or would consider working, so thought that they were likely to work in the future. So I haven't looked at this since March, but I do know that overall flows out of inactivity into employment have continued to increase since then, and I wouldn't be surprised if part of that increase were driven by sort of recent retirees returning to the workforce.
Great. And then similarly on leaving the workforce, another question asking about whether decisions to leave the workforce are driven by a change of attitudes from the pandemic, resulting in people perhaps saying they've had enough income to retire or so on, rather than wanting to work more and earn more. I think that's something we can speak to a little bit, isn't it? So yeah, Xiaowei, I'll pass that one over to you again.
I'm not sure. I think it's sort of hard to get at that. So I guess our hypothesis would be that the 2020 cohort of retirees look a bit different because that's the group that, you know, have had this attitudinal shift and they sort of feel like they're able to retire on less incomes, and therefore you see that drop in living standards. I think it's possible. I think sort of 2 points. Like one, the fact that you do see these declines in well-being among that cohort suggests that maybe that's not so much the case, that it's sort of an active choice to retire. But also I think, you know, the sort of level of income you need to maintain a good standard of living that people thought was perhaps adequate at the time might no longer be the case now with the cost of living crisis.
Yeah, indeed. I think it's something where it would be really helpful to have more data. We might be able to get more data coming online soon through another survey, which specifically looks at older workers, which might help get a bit of a grip on some of these questions. I think it's really important, interesting issue. There's a question, Tom, I want to send your way, a question about regional inequalities. Has the difference between England, and this person's asking about England versus Scotland, Wales, and Northern Ireland, increased or decreased? What evidence is there that the devolved Scottish Government welfare payments are having a positive effect on poverty reduction? Now, that isn't something we looked at specifically in this report, but that is some work I know Tom's been, some issues that Tom's been looking at in some other work. So is that something you can comment on, Tom?
Yeah, so the Scottish Government has made several changes to the welfare system using devolved powers. So there's increasing divergence with the rest of the UK, and the main effect of that is to increase the incomes of households with children. The Scottish Child Payment and Best Start grants are providing quite significant amounts of money to lower income households with children, around £2,000 per year extra. Now, given that a lot of those payments either only came in recently or only increased recently, we don't yet have official income statistics to see the impact of those, but these are very significant amounts of money. So it seems highly likely that these payments are going to be reducing poverty, and in particular child poverty to some extent. I think the Scottish Government modelling suggests that it could be around a 5 percentage point decrease in child poverty, and something of that magnitude does seem quite reasonable, given that these are significant boosts to the incomes of lower income households, funded by increases in taxes on higher income households.
Yeah, indeed. I think it's an area where it's perhaps not really appreciated, at least outside of Scotland, quite how big some of these reforms are. That for low-income families, specifically low-income families with children, we are talking about really quite an important change in the size and the shape of the kind of level of support the government provides, and evaluating that in the coming few years when its impacts, I think it's really going to be a really important thing to do. Skipping down a little bit, there's a question, perhaps I think I can speak to this question about evidence about changes in poverty depth and or destitution. Are people having to cope with very low or zero incomes for short periods due to gaps in social security provision, for example, 5-week wait and universal credit? I think this is a key question, because the poverty statistics that Sam showed there, we're looking at this headline measure of poverty, it's kind of roughly 20%. But it's just, are you above or below this particular line? And you might wonder, well, you know, it's worse to be further below that line than only just below it. And so perhaps something else is going on with really deep poverty. And this is something we looked at a few years ago, and when we looked at it then, it didn't seem like there was too much of evidence of really deep poverty on the rise. But there has been more work done recently, which I think does suggest that this sort of deep poverty or destitution might be increasing. It's the kind of area where it's a bit difficult to get a handle on with the data we have, because we're dependent upon this survey data where people are reporting, you know, what benefits they're getting, how much they're earning, and so on. And if people's, you know, become less, don't report incomes that they have, we don't know about it. But that is something where, in principle, the DWP can improve matters, because they can link these data to administrative statistics on whether or not people are getting these benefits or the earnings that they're getting, and there are some plans to do that. So I'm hoping that in coming years we're going to be able to be a bit more precise about some of these really low levels of living standards that historically we've struggled a little bit to really comment upon.
Just on this question of measurement issues towards the bottom end of the distribution, it's also quite difficult with the survey data that we have to distinguish sort of deep poverty from income volatility, because typically what's asked is about your income in the last month. So if you have very volatile incomes, then that often shows up as, you know, a big increase in share of people with very low incomes in any given month. And certainly in the years leading up to the pandemic, we saw a big rise in self-employment, especially towards the bottom end of the wage distribution. And given that self-employment incomes tend to be more volatile, we could expect that to turn up as sort of an increase in this measure of deep poverty.
Yeah, absolutely. Great point. Well, another one on methodology. You know, this is an IFS seminar because we've got one of the top voted questions is about survey representativeness. So Xiaowei, I think you looked into this a couple of years back. So there's one of the questions here is, how robust are post-pandemic, or presumably mid-pandemic as well, household surveys as fully representative, given the changes that were forced in survey methodology in the pandemic? That is
a good and absolutely huge question. I think the short answer is it depends on the data set. So yeah, as this person says, there's been, you know, over the pandemic, everyone switched to online or telephone interviews rather than in-person interviews. A lot of surveys saw a big drop in their sample size and response rates. And I think it is quite possible that, you know, some of that would have affected the representativeness or the quality of the surveys. That said, at least certainly in some surveys, there have been attempts to address the balance. And it's sort of why we've been quite careful in most of our research to look across a number of data sets. So for example, on the research on the living standards of recently inactive people, we look at 3 separate data sets, and they all sort of tell the same story, including a panel data set that follows the same people over time. So with that sort of data, it's easier to to adjust for non-response, because you know a lot about the characteristics of these people before the pandemic hit. So I think it's definitely an issue. We're very conscious of it, and sort of double checking across different data sets.
Great. We'll stay with you for the next question, shall we? It's just someone asking specifically about the work on inactivity. Where we see this increase in anxiety amongst those who had just left the workforce in 2020, could that spike not simply be reflective of the COVID experience equalizing anxiety across the population? Why would you assume a similar spike across different types of older people given lockdown?
I think that's a good question. I think the fact that the spike in anxiety and also other measures of poor well-being is so much larger specifically for the group of older people who just retired that year, compared to people of the same age groups who retired earlier, compared to people of that age group who remained in work, suggests that it does have something to do with the movement into an activity rather than just an overall population-wide decline. I think you need to come up with quite a complicated story to explain why that's specifically that group, if it's not related to them becoming inactive. But yeah, no, I think that's a good point.
There's a lot of questions about social care and unpaid and care for disabled people giving care to relatives and so on. I don't think that's something, unfortunately, that certainly that's something we looked at in this report. I'm not sure if that's something that anyone on this call at least can really speak to. So I'm sorry we can't come to that. If any of my colleagues here do want to jump in, please do. But I'm afraid we'll probably have to pass those ones. There's a question here about what effect does the withdrawal of child benefit and other benefits for third and subsequent children have? So this is policy sometimes known as the two-child limit, which means that if you're on universal credit or if you're still on tax credit, not that many people are anymore, you can only get benefits for the first two children in the family. So you get roughly you get an extra £3,000 for every child, but that's now capped at the first two children. And the way the policy was rolled out was it only affects children born since April 2017. And so it's about halfway rolled out now. Obviously, over time, more and more of children in families are born after April 2017. So the policy sort of slowly rolls out. I think this is a very important policy. And we do have good evidence that larger families with at least 3 kids, their poverty rate has been increasing. It was always a bit higher than smaller families, but has been increasing over recent years. So it does look like it's having quite a material effect. And there's more of it. There is, as I say, more of it to come because it's only roughly halfway rolled out. We have another strand of work where we're going to try and look at what impact this policy had on children's educational outcomes. What happens when you give more or take away more cash from families. So I don't know if there's anything you want to add on that. I know you looked at larger families
I think just that overwhelmingly the trends in overall child poverty rates that we've seen over the last couple of decades are driven by trends in for this group of people with large families, right? So if you sort of look at child poverty rates over time by size of household, it's really just that one group with 3 or more kids where you see big fluctuations over time, whereas everything else looks pretty stable. So yeah, and the poverty rates are very, very high among that group. I think it was about half of kids living in families with 3 or more children are in relative poverty. So sure, I would definitely expect changes in policies affecting benefit policies affecting large parent. Can't talk today, large families to have a big effect on overall child poverty rates.
There's a question here for you, Sam, perhaps a somewhat tricky one. So it says, you stated there's been a fall in absolute and relative poverty since the pandemic, but we've seen the number of food banks, number of use of food banks, perhaps, or maybe means the number of food banks itself, doubled in the last 5 years, and the number of food parcels being issued has also doubled. Do you have any reflections on that? Why they seem to be kind of contrary trends?
Yeah, I suppose this maybe talks a little bit to what we were saying earlier about differences between kind of depth of poverty and the fact that when we talk about these headline poverty measures and poverty rates, we're looking at what is the number of people who are below this poverty line. And so if there were, I mean, we don't have any evidence in this report that really speaks to that necessarily, but if there were changes increasing the depth of poverty, then you might think that might cause people to rely on food banks more. I think also, there's been sort of rising prices that we've seen as well. And although sort of benefits have helped keep real incomes reasonably stable, then, that might lead, people might still sort of be having to change their spending around and be kind of relying on these sort of food banks more.
Yeah, I think that's right. And an important aspect of the cost of living crisis as well is that because so much of it, at least to start with, so much of it was focused on rising energy prices. Obviously, it's become more widespread since then. It affected different households very differently. So it's been widely reported how it's affected poorer households more because a larger fraction of their budget goes on energy. But even amongst households of a given level of income, there's very widely varying amounts of their budget that goes on energy, and therefore how much they're affected by the cost of living crisis. And so you could imagine that for a given low income household who spends a lot on energy, they might be really substantially affected in a way that's not really picked up by the official poverty statistics, but might result in them needing to go to a food bank or similar.
Yeah, I think that's actually quite a good point that I think deserves a caveat around poverty measures in general over this period. Because when we calculate these relative and absolute poverty rates, we're deflating incomes across the board by the same measure of inflation. But of course, we know that because of the composition of spending and how that differs across the income distribution, poorer households are actually facing higher rates of inflation than sort of middle and higher income households. So yeah, I think levels of poverty are probably higher in real terms than our figures or the official figures would suggest.
Yeah, I think that's fair. I think that's right. Another one perhaps for you, Sam. Someone here asks if the cost of living payments weren't effective poverty reduction measures, do you suggest any alternative measures to help keep people out of poverty during the cost of living crisis?
Yeah, so obviously there's a kind of huge range of possible potential policies, but I think quite a natural comparison, and one we sort of allude to in the report, is that really the sort of issue that the cost of living payments are trying to sort of deal with is the fact that benefits and benefit rates are falling behind inflation. And this is because every April they're uprated, but this is using inflation rates from September rather than April. And so really what this is sort of dealing with is the fact that benefit rates are just below where they should be. And so what kind of we suggest is that if you just kind of increase those benefit rates to kind of make up for this fall, and perhaps the government should think about maybe a more sensible way of uprating that reflects the fact that we have kind of more technology now and these payments are just going straight into bank accounts, then really that seems like a much more sensible policy. And this would kind of, within the same sort of administration that we have at the moment, be smaller, more frequent payments. It would be targeted kind of in the same way that universal credit is generally. And so that would solve some of the issues that we've highlighted with these kind of big flat rate payments.
Yeah, I think that's right. Since this event started, Neil Cooling, who is the sort of the senior civil servant for Universal Credit at DWP, has tweeted IFS and me saying that it's difficult to uprate benefits in a short period of time, because although they can do it very quickly for Universal Credit, they can't do it quickly for the other benefits, and it would be it would cause kind of an unequal treatment if they only did it for Universal Credit. And I think that does actually highlight a real bit of a weakness in the infrastructure of delivering benefits, which thankfully is being addressed by Universal Credit, that we just simply can't change benefit rates very quickly, because of the way that the sort of the administration all fits together. And so, some time ago, I came across a debate in Parliament in the 1980s, which recorded in Hansard, where I think it was a shadow minister said, you know, we have this thing, we can only uprate benefits based on the inflation of 6 months previously, but can't we fix that now? We've got these newfangled computers coming in, and that was in sort of 1985 or something. And so 40 years have passed. We certainly have newfangled computers, but unfortunately, for benefits other than universal credit, we still are quite limited in what can be done there. I think we're kind of getting towards the end of the questions that we can clearly comment on. There's a couple of questions about people who have been left out of various policies. So weren't there some groups of claimants who didn't get the uplifts? So, same with the cost of living payments too. I'm thinking of people on carers allowance. That's true. And is there any data on the population who are ineligible for the support schemes during the pandemic? I'm thinking in terms of the SAY scheme, which was the equivalent of furlough for self-employed people. I'm not quite sure yet. Not sure if any of my colleagues want to jump in on any of those. I suppose it's true. I think it's one quite important thing about these sorts of schemes, like the cost of living payments and furlough and SAYs, is because they've been developed sort of on the fly, if you like. They have certain kind of, they had or have certain gaps in them, which perhaps if you were designing something in sort of a perfectly ideal system, you wouldn't have. And it does seem to me that there's a case for the government actually thinking about how can we set up infrastructure now so that we can, in an efficient and targeted way, deliver cash to people we want to in some unknown future crisis. Perhaps that'd be something for a government to consider. I don't know if anyone else wants to jump in on that.
I mean, we did look previously at some various subjective measures of well-being, and we found that there's big increases in arrears on bills amongst self-employed people, likely related to just the point raised in the question that it was very patchy eligibility, sort of some very strict cut-offs, which perhaps meant that the payments weren't very well targeted. And other work we've done as well, suggesting that self-employed people more reliant on their own savings, again, probably as a result of the fact that some of them didn't have these payments. So yeah, there is some evidence which sort of supports that line of thinking, that the patchiness of the schemes did mean that all those groups, there were significant increases in significantly higher increases in deprivation by some measures.
Yeah, I think that's right. I think there's also something to be said about these like very rapidly rolled out sticking plaster solutions that then become long-term solutions over time. So the furlough scheme, for example, which was rolled out really very remarkably quickly at the start of the pandemic, but then endured for 2 years into the pandemic. And similarly with the cost of living payments, when they were first introduced, perhaps it was very difficult to uprate benefits within such a short time frame, but now we're seeing these cost of living payments carry on for 2 years.
Yeah, absolutely. Okay, excellent. I think it might be best to call it a day there. Thank you so much for everyone who's been listening to this. I hope you found it as stimulating as I have, and thanks again to the Joseph Rowntree Foundation for funding this work and making it possible. And we will look forward to seeing you about this time next year when we look at what's happened with next year's data.